ServiceNow, Paul. ServiceNow.
Oh, their ticker symbol's now. That's awesome. Okay, what do they do? ServiceNow provides software solutions to structure and automate various business processes via a SaaS delivery model.
I apologize for that phone, guys. Paul, I didn't even know, Paul. Somehow my phone goes through to the board, yada, yada. You should see the studio, guys. We'll do a lot. We should do a live.
Why don't you just disconnect the phone from your board?
Well, I'm not that smart, Paul. We're not all
take
you.
Bluetooth off, genius.
I just did that now. Thank you for smashing the like button. We like you guys. We love you guys. Appreciate it.
And another high profit margin business, guys. No, this is kind of recent write-offs. We're fine. $100 billion market cap. 150 PE. Everybody, relax.
Ain't nobody got time for that.
I don't think it's that big of a deal right now. This is still an X. I don't think this 150 is real. So just relax, everyone, before everybody starts hyperventilating and going crazy.
I am already. Keep going.
1.1% profit margin. It's an X again, but again, I don't think it's real. Their gross margin is 78%. Here's why I don't think so.
Go on.
Their trailing 12 months income is $700 million on $4.2 billion. That is roughly 17% profit margin. And on a $102 million, it's still really high, but it's still about 100 and some. But let's go see if there was some major write-offs or lack of income here recently, and that's what caused this massive jump.
Profit growth over the past 5 years?
Revenue growth we want to do first.
Revenue growth, sorry about that. Revenue growth, pillar number 3.
How many stocks have we done? Like $1 billion and you still don't know this thing? Okay. $1 billion to 3.4, check mark. I had to think, oh wow, look at this. 10 years ago they did 73 million. 73 million.
Look at that, Paul. Would you look at that?
They must have done some major acquisitions here or something. Somebody find out they did it. Oh, we can find out ourselves. That's pretty awesome. Big jumps.
Profit growth, pillar number 4.
Let's look at their operating income real quick. Ooh. Ooh. Oh, their net income just recently started making money, guys. All right, so negative 200 million to a positive 626. It's a check mark, but not that great. Number of shares outstanding,
Pillar
awful. 155 to 186. Jesus Christ.
Not awful, Paul.
155 to 186?
20%? 20%?
Increase.
Yeah, that's bad. Okay.
In shares outstanding. That means for every share you owned before, now you own 1/6 of that same share.
Current assets greater than current liabilities. What are you thinking of this company already, Paul?
$4 billion versus 2.8. Check mark there. Almost enough money to pay off all their liabilities, though. That's pretty cool. Listen, this might be like a really growing company, and that's why they have this issue.
This is ServiceNow.
I need you now more than words can say.
Paul, if you sing too well, they're going to spike this video and take away monetization because that voice of yours.
All right, you ready, Big Shot?
Go on.
So first off, we're at 220 million, and now we're at 900 million.
Wow.
So definitely check mark there. So guys, this is a fast-growing company, so we're going to want to pay a much larger. Just go ahead. 35, 490, 660. So 220. 35.
I got it. 441. What multiple are you choosing, Paul?
30.
Why is that?
Because it's fast growing. It's quadrupled in the last 5 years. And guess what, guys? 13.2 billion. What's the company selling for right now?
Drum roll, please.
102 billion. So it's going to drop 87%.
Do you like it?
I mean, it's currently selling for 120 times free cash flow. No, 200. It's currently selling for 250 times. No, okay. So the last year it's selling for 110 times free cash flow. It's selling for 250 times 5-year free cash flow. I mean, you decide what you want to do. I'm not touching this thing. I ain't touching it. Let's go look at their quarterly numbers. I want to see their quarterly numbers. What's causing these massive fluctuations?
Yeah, this thing's skyrocketing.
I like the operating incomes going up. Look at their revenue quarterly. It's definitely up a lot. I mean, they're growing like crazy, but you still, just because it's growing doesn't mean you pay whatever you want for it. Why not pay $200 billion for it then? You still got to sit there and say, what's that future stream of free cash flow going to be worth to me today?